Hi, everyone. Happy Thursday. You got Rod Crandall here, Chief Integration Officer at U.S. Advisors Insurance. Thank you so much for joining us. This is a series that we call the Coach's Corner. We get together on the third Thursday of every month, trying to bring you timely topics, trying to bring you actionable items so that you can effectively, intentionally integrate insurance into your practice. I'm really excited today. I have a co-host with me that I'll be introducing in a moment, Andrew Herrera from North American. Many of you may be aware we do have significant changes coming May 1st, and we're going to be discussing that. We're going to be covering a few things here today in the next 45 or 50 minutes. There is some changes called AG49-A, and so to the extent that you're aware of this, there has been some changes that have updated that. If you're not aware of it, we're going to let you know what that means. It has changed how we can illustrate products, specifically IUL products. Andrew's going to give us the summary on what that means, but more importantly, what do we do with that information moving forward? Then we're going to talk a little bit more about North American in general. They're one of our best carriers. You know, we are brokers and we work with multiple carriers, but when you look at all of our carriers, North American's right at the top for a lot of good reasons. So we're going to hear a little bit more about their company and some of the products and solutions and tools, resources that they can bring to us. At the end of the day, if we understand what kind of changes are being made and how we might be able to use North American to help serve our clients, then we're going to finalize with, what does it mean to do this work intentionally? Because what we find is that if you really want to do insurance planning, you really have to do it on purpose and you have to do it with intention. And at the end of the day, that's really what we help advisors do here at US Advisors. We're going to give you a couple of tips on how to have great conversations by identifying the right kind of clients to talk to about the right kind of things. Then we're going to share with you a couple of resources, one of which is very cool. It's about 6 ideas on how to increase IUL business directly. And so we're going to cover that in approximately the next 45 to 50 minutes. And so with that, what I'd like to do is stop sharing and send the screen over to Andrew Herrera. He is our regional vice president at North American. He's become a good friend of mine over time, and he does a great job in his role. And he's going to walk us through some of these changes and again give you a couple of ideas and share some info on North American overall. So with that, I'll introduce you to Andrew. Take it away, buddy.
Thank you, Rod. Appreciate the opportunity to partner with the U.S. Advisors and to be with you all this afternoon. So, as Rod mentioned, there's a couple changes that are really impactful that are coming to the life insurance industry here in about 11 days or so. And it revolves around regulation that's being updated, that's impacted specifically index universal life over the last several years. And I want to take the time to obviously go through that and just talk about what the changes are, what the impact is going to be on the industry, and more important, where do we go from there? What sort of opportunities? I think it's probably the most important part. Do we have in front of us? So, like I mentioned, go over the new regulation, talk about what the update is, talk about the opportunities, and lastly, talk about why I think North American, should be a carrier that you consider if you're not already, sending business our way. So to talk about AG49-A and the update we're going to see on May 1st, I want to first give a little bit of background on how we got here. If we think about, life insurance illustrations, there are certainly some guidelines and regulations, surrounding them. And these date back probably, especially as it relates to universal life specifically, 1997 is when we saw the first model regulation that the NAIC put in place on then, would have been current assumption universal life. But really the one that most impacted our industry and IUL specifically didn't arrive on the scene until 2015, and that was Actuarial Guideline 49, or what we commonly call AG49. And the reason it happened, 2015 was not the year that IUL was developed. It had been around for probably around a decade at that point. But what was happening in the IUL space prior to then is carriers really had no guidance from the regulatory agencies or anybody on how to illustrate index universal life. And so a carrier could arbitrarily say, yeah, we're going to illustrate a 7, 8%, maybe even 9% on our IUL, and they didn't have to justify how they arrived at that point. Again, there was no guidance on the illustrations or regulation around that. And so that's when AG49 arrives on the scene and says, okay, listen, if you're in the Index Universal Life IUL business as a carrier, we're going to provide some guidance with you on how you arrive at an illustrated rate. You need to be really looking at your look back based on a number of different factors. And from that point on, we had some guidance on what IUL illustrations could do. And at that point, you saw a lot of them come down, right? A lot of those carriers that were showing, 7, 8, 9%, a lot of that came down after 2015 because of the new regulations put in place. But what carriers did after that was they realized, okay, AG49 is saying that we're limited to this box on what we can show on an illustrated rate, but it says nothing about something like a multiplier that we can put on in addition to that. And so we can say as a carrier that we're illustrating 7, 8%, whatever it is that fits within the AG49 parameters. But if we add a multiplier to a product, we're really illustrating a lot more. And so you saw this emergence of multipliers on IUL products, so much so that even though the illustrated value might say that they were illustrating a 6 or 7% behind the scenes, with the multiplier, oftentimes you were really illustrating 17, 18, 19%. Well, of course, that piqued the regulatory agency's interest, and they said this is not the intent of what we wanted with the original AG49 in 2015. And so we're going to provide some additional guidance. And that's where we got what's known as AG49-A, which occurred in 2020. AG49-A did not remove multipliers from policies. It simply said you can no longer illustrate them. And so a carrier that has a multiplier on a product back then, and even today, there's still multipliers on some products. You can still have the product. The client, of course, could receive that multiplier, if the index performs and triggers that, but you don't see that on paper anymore. You can't illustrate the multiplier's effect. So really, again, there's some carriers that still have multiplier, but a lot of carriers moved away from that because they thought, if we can't illustrate it, we can't show it to the client, there's really no benefit, and so let's move away from that. And fast forward to now, of course, carriers are innovative. That's what they do. They said we can't show, we can't illustrate multipliers anymore, and so you saw an emergence of bonuses, and specifically volatility control indices that have additional bonuses and whatnot. So it got to the point where we're at today, where regulators are saying, okay, let's take another look, because we're not sure that the industry is going where we want it to go in terms of how these products are being illustrated. And we're going to provide some additional guidance on that. And the most recent one, which again will go into effect on May 1st, really came down on volatility control indices. And the argument was that you can't have a volatility control index, which many of them that carriers have, by the way, are proprietary, us included. We have our own Fidelity volatility control index on North American's products. But what they decided is that those volatility control indices should not be allowed to illustrate a higher return than your S&P 500, right? Which we kind of call the plain vanilla index option, S&P 500. And the argument, and you can agree with it or disagree, but the argument was that, today's environment, these volatility control indices are illustrating higher than the S&P 500, but they're not sure that they can actually outperform them in a given year. We would argue the opposite. And a year like last year, we saw that in our own policies, because our volatility control index includes a 1.65 bonus. Well, if you had your money in the S&P 500, of course, we know the market was down. The great thing about IUL is you do have a floor of 0. And so clients would have not experienced a 20 or 30% loss in their IUL products. They would have hit, the floor of 0. Our volatility control index, since it has a bonus of 1.65, we actually credited policies in a down year 1.65%. That's a benefit of a bonus over a multiplier. As a multiplier, regardless of how high the multiplier is, it's always going to be 0 when you multiply, the multiplier times 0. In a bonus, you can still have a 0 year. The index can still return 0, but the bonus still gets credited to the policy. And so, of course, our argument and a lot of other carriers was that, there is a place for volatility control indices, and bonuses do work. And last year was a clear testament to that. But again, the regulatory agency decided that, we're going to move forward with this, and, we're going to restrict what really, these volatility control indices can illustrate. And so there's this renewed emphasis around S&P 500. What's going to happen May 1st is illustrated rates on volatility control indices, which again, every leading IUL carrier has a VCI index, and it's most likely their proprietary one or certainly a default option on the product. That illustrated rate is going to come down, because regardless of how it actually could perform in real life, with the update to AG49-A, it cannot out-illustrate the S&P 500. And a lot of that has to do with the options budget that a carrier has and whatnot behind the scenes. There's no impact to the bonus, right? So the bonus we have on our volatility control index 1.65, that's not going away. Clients will still receive that. Again, we just won't be able to show them on paper the benefit of allocating money to that index. At least certainly not to the extent that it outperforms the S&P 500. So, if anything, I think the message here is one of perhaps diversity, right? That one should be diversified in a number of indices with respect to IUL. But I think probably the biggest thing that we can take away from this is, as an industry, how have we been promoting this product? Has it been concept driven? And I think there's some good advisors, some good producers who have absolutely done that. They've remembered that this is life insurance first and foremost, and it provides a tax-free death benefit. And in addition to that, you can have tax-deferred growth and, of course, tax-free income. And the client understands that and recognizes this illustration is purely that. It's just illustrating an example of what could happen. But we know others really, sell the illustration as the end-all, be-all, and this is absolutely the income you're going to receive in this product. And so I think for those advisors, those producers that are doing the latter, unfortunately, May 1st is going to be a wake-up call as, the illustrated rates come down, as those volatility control indices, as what you can show on those comes down. I think those advisors that have been leaning on the illustration as a crutch will be impacted. But the others who have been selling it, the way it should be sold, perhaps will see no impact. I'm just showing you here a competitive landscape of what things will look like after May 1st here in a couple weeks. Our income, this is looking at a 45-year-old traditional max funded, LERP type scenario. North American, you can see we've got a competitive product. Prior to the changes in May 1st and even after the changes on May 1st, we will still be a top 5 IUL competitor. At the end of the day, regardless of these regulatory changes, we still want to provide you, and certainly the end consumer, a competitive product that will perform over time. So what happens next, right? If you're thinking, man, with these changes, where are carriers going to go to next? What are they going to pivot to? Certainly, we think there might be a renewed interest to, variable universal life. I don't imagine a large influx there, as most producers won't want to get, the licenses, that are required and have that extra regulation from FINRA or whatnot. And so we're not sure, if that's going to be, a big spot. I think there'll be some, growth in the VUL market, but probably not, large growth. Probably the most thing that we're seeing that carriers are doing is considering, and I think there's a few carriers that may have actually done this already, creating a new portfolio. And so what I mean by that is today's interest rate environment is higher than it has been in a generation, right? Our actuaries at North American joke that they've been creating products in a declining interest rate environment since the day they graduated, and got their actuarial degree, and that was, 30 plus years ago. And this is the first time that we've actually seen rates climb. So many of you, if you're in the annuity market, you know firsthand, right, that annuities are hot in large part because rates are hot right now. Life insurance doesn't have that benefit because it's portfolio rate driven. And so what happens is new money comes in today, into life insurance via sales, and that slowly lifts a portfolio's overall rate, right? But you know, they've been receiving premiums for decades in a life insurance portfolio, and so these bonds are kind of laddered, and that's how you arrive at your overall portfolio rate. But it doesn't move as drastically as annuity, which is a new money product, would. But like I said, life insurance carriers today are saying, you know what, rates are higher than we've ever seen. If we can create a new portfolio, we'll call that Portfolio B, that we launched today, and build a product on that portfolio, it will immediately get the benefit of today's higher interest rate environment. And we can have a more competitive product, right? Take advantage, almost like creating a new money product, like an annuity, but in the life insurance space. And so, like I said, carriers are really weighing whether they want to do that. And I think there's a few carriers that have already to provide a more competitive product and to certainly take advantage of the higher interest rate environment. So there's a lot of things that carriers are looking to do. Probably over the next coming months, you'll see carriers make decisions on which way they're going to go. But just expect changes after May 1st. Certainly, the most drastic change we're going to see is on the illustration for every single carrier, but also I would expect some product changes later this year. So again, that's a lot of regulation, a lot of update, a lot of history on how we got to this point. But I really think, again, what these changes do, and it reminds us, what is this product supposed to do for a client? Where does this product fit in a client's overall portfolio? What are the opportunities that we have today? I mentioned earlier, who I thought was going to win at the end of the day, right? The producers who were doing this right, who recognize, the concept is more important than what's on the piece of paper. I think those are the advisors, those are the producers that will win at the end of the day. And if we think about life insurance and where it fits in the spectrum, it's, I think, good to remember all the things that it provides. It certainly provides leverage in that the dollars I use today to purchase a life insurance policy can be leveraged into a much higher death benefit. And by the way, that death benefit is not just something that can be used if I die, right, for my heirs, for my loved ones, but it's also something you can tap into for living benefits. And I'll talk a little bit about that, more about that later. Life insurance is also the only tool we have that provides a tax-free death benefit, tax-deferred growth, and tax-free income. So it's a tax-advantaged asset. It provides risk protection, right? I mentioned last year when the market dropped dramatically, money in a cash value life insurance, like an index universal life, would have not gone down 20% or more last year because you have that protection, that floor. And certainly the living benefits, right? Critical, chronic, and terminal illness riders you can tap into. I may not die too soon, knock on wood, but what if I get sick along the way? Can I use my life insurance policy for that? One of the studies that I read recently was one that Ernst & Young provided as it relates to life insurance as part of the client's portfolio. And, if you can see here, it talks about, permanent life insurance and deferred income annuities, increasing income potential, outperform investment only approaches in our analysis. What they did is they did a study, Ernst & Young did, of different retirement incomes. They looked at different couples. They ran over 1,000 Monte Carlo scenarios. Jack and Jill, who are 25 years old, they looked at couples in their 30s, couples in their 40s, and they said, what if these individuals, for retirement purposes, only did AUM, right? So what if they just allocate all their money to AUM, and we played it out long term, they're in retirement, they start taking income, and again, over all these different scenarios, how does that play out? Then they said, what if they do that, but they also combine that with term insurance, right? So a lot of you may have heard the saying, buy term and invest difference, or buy term, invest the rest. What does that look like in real life? And you play that out across, again, these different couples, different ages, these different retirement scenarios. What does that look like? Then they looked at what happens when you incorporate permanent cash value life insurance, and in this situation, deferred income annuities. And of course, they segmented each one of those. What if you only do annuity? What if you only do life insurance? The best retirement, scenario was the one that incorporated not just AUM, but AUM plus permanent cash value life insurance plus the annuity option that they looked at. And they said this made the most sense. You have the highest probability of winning in retirement when you incorporate permanent cash value life insurance. And I think that's a story that often we forget. We forget that this should be, an additional asset to a comprehensive portfolio for a client. Certainly, if we want our clients to win in retirement and have the best odds of winning in retirement, this should be a part of the conversation. And they look, again, I keep pointing to last year, and I think it's easy to because we saw what the market did last year. But can you imagine a client in retirement who only had AUM, and in a down year, they need income, right? They're in retirement, they need income. That's what they're living off of. To be forced to sell when the market is down and not have diversified into other assets is a mistake, right? And we know that with cash value life insurance, that would have been a perfect year if a client had a cash value life insurance policy to say, when the market's down, I'm going to let those assets rebound, which we know historically they're likely to do, and I can pivot and pull from this bucket. Not only for that, balancing out, but for tax purposes too. What happens if taxes go up in the future, which most people I talk to agree that they think taxes are going to go up in 10, 15, 20, 30 years, regardless of what side of the aisle you're on. I think people see the amount of debt that we have and the obligations we have in this country, coupled with the fact that we're in a historically low tax rate environment, and people think taxes are likely to go up. Should we be doing more in a tax advantage asset? Which leads me to what you're seeing here. This is probably something you've seen before. Maybe you've seen a tax triangle or a similar piece talking about this. But when we think about where clients today in the United States are putting their retirement money, more often than not, it is, a tax deferred solution, with most people probably utilizing, their employer's 401k. There's certainly nothing wrong with that, right? Especially if your employer has a matching program. Why would you leave free money on the table? Take advantage of that. But if that's the only thing they're doing, if they're putting all their eggs in that basket, is that being well diversified? If taxes go up, why would you delay your retirement tax bill until the future when taxes might be higher than they are today, right? And so I think the bucket that people use the least is a tax advantage bucket with things like a Roth IRA, a Roth 401k, and certainly cash value life insurance. I'll show you briefly here a couple of examples I've talked a lot about the different scenarios, but I want to show you, how these products actually work. What we're looking at here is a 50-year-old male. He's got $1 million of invested assets, and he's just going to peel off 3% here and fund a non-correlated asset, i.e. life insurance. And he's going to fund that for 15 years to age 65. Like I said, first and foremost, this is life insurance, so it does provide a death benefit, but it's also going to allow him to diversify, perhaps for supplemental retirement, diversify so he can have a tax advantage asset. Or maybe, if God forbid he gets sick along the way, he can also tap into it, for those purposes as well. So you can see the 3% here equals 30,000. That's premium. We're doing that paying for 15 years. Perhaps he's identified with his advisor that he'd like to retire at age 65. And then he starts taking income immediately after that. I've dialed down the illustration. If you're looking at the column all the way on the right to 5%, I'd rather be more conservative with this illustration. Certainly, we can illustrate a lot higher than that. But again, I prefer to use this to illustrate with the client what the concept is and what it can do, and I'll have the client, look at the income numbers and say, oh my gosh, I'm guaranteed to get, in this case, over $41,000 a year. Like I said, I could illustrate this a lot higher and show a lot higher income, but I'd rather not do that because I don't want the client to walk away from this meeting thinking that's absolutely what they're going to get. And so again, I'm more conservative in this illustration, but you can see we've run income here all the way to age 85. And oh, by the way, even after income is done, there's still residual tax-free death benefit that would pay out if he were to pass away, that would go to his beneficiaries. So who would benefit from a solution like this, right? We're talking about diversification, max funded life insurance, having this additional asset. The people I think of immediately are high income earners. High income earners, because they're likely maxing out what they can do in a 401k. Maybe they don't even qualify for a traditional or a Roth IRA, and they need that additional bucket to save into. Otherwise, they're going to have a huge retirement gap, or retirement income gap in the future, right? Business owners are also people we see that utilize this strategy a lot because they're already doing, likely a retirement plan at their place of work for their employees, and they're saying, I want to do something just for me or just for me and my key executives. We want something that allows us to go above and beyond what we're offering, to the masses, at the company. Is there something we can do just for ourselves? Typically, I would say ages 35 to 55, maybe a little bit older than that, you can still have a scenario like this work. What we don't like to see is someone come in at 62 or 63 and try and do something like this and say, I'm going to fund it for 3 or 4 years and then immediately start taking income. Ideally, you would have, a longer runway, because this concept really only makes sense if you're going to fund it for a number of years. The longer you can let it grow, the better off it'll be. So I typically say, if you have less than 5 years, it's probably not going to work. And certainly, this is, like I said, this is life insurance, so they would need to qualify. They need to be healthy enough to go through underwriting, and they need to have a death benefit need, right? But certainly, another type of client is someone who's approached you and said, hey, is there any tax advantage solutions out there that I'm not taking advantage of that I can? This would be certainly a good solution for them. So now I'm going to pivot. I've talked a lot about, accumulation type scenario. But what about if you have a client who's more protection focused or legacy minded, and is thinking about, how do I leverage the dollars today to leave on something bigger for my kids, for my grandkids, for my church, for a charity, whatever it is. And so I've taken the same individual here, same 50-year-old, same $1 million of AUM. We're taking the same 3%, but now we are funding a guaranteed death benefit. So the focus here is not on the cash. The focus is we want a guaranteed death benefit to pay out when he dies. That $30,000 a year for 15 years is buying us over a $1.3 million death benefit that is guaranteed. So regardless of what the index does, now you can see that there's still cash in this policy, that if the index returns, even to 3%, you can see in that middle column how the cash performs. And on the right, again, I've dialed it down to 5%. It does fairly well, especially for a client who didn't buy this for cash. It still provides some cash options. But more importantly, it's got that guaranteed death benefit, which, by the way, we can dial all the way to age 120. Another neat thing on this product is it has a return of premium feature. So the client can change their mind in years 2025 and walk away with 100% of their premium, which you can see here. I've highlighted $450,000. That's an option if the client wants to walk away. So even if the index doesn't return and the cash, let's say the cash value is zero in 20 years, we would still provide them with $450,000. We would refund their premium if they want an exit strategy, they change their mind, they want to walk away. But you can see that if the index does perform, they're likely going to have a lot more than the $450,000 if they wanted to walk away. But it's nice to know that the client has that safety net, again, in years 2025 as an exit strategy if they do want to walk away and get that return of premium. The other thing I think when we think about death benefit, and the leverage here is the internal rate of return that can provide for a client. And I'll talk about that here in a second. But I like to highlight here, what if a client didn't want to do that? And it's kind of a little bit, it goes back to the Ernst & Young study on, what's better? Is it AUM or is it AUM coupled, with life insurance and other things like that? If the client took their $1 million, and we're assuming a 5% rate of return here, compounded annually, we know that it's going to grow. It's going to grow over time. And that $1 million will grow for the next 30 years. Again, we've got a 50-year-old, so that takes him out to age 80. But if he were to peel off 3%, still leave the 97% of AUM invested with the 5% return, that death benefit that he gets, that's guaranteed, that's added right to his overall assets, right? So if he's thinking, if I were to pass away, how much would my kids, my spouse get? If he left the money just as pure AUM, again, that would grow. But if he died, that's what they would inherit. But with that higher death benefit, you can see the portfolio with life insurance, is the lighter green line, outperforms the portfolio purely without insurance. Now, of course, if he were to get maybe a 10% rate of return, which I would argue is unlikely, that portfolio with pure AUM would likely outperform this one. But if the market were to go down, that guaranteed death benefit is never going to go down. So at least that portion of his estate is protected as far as the value of that. If he were to get sick along the way, he would be able to tap into that death benefit and use that to offset medical expenses. And you can see here, take him out to his life expectancy, the portfolio with insurance wins today. But I did mention the internal rate of return, right? So at his life expectancy, the internal rate of return, if he were to say, you know what would I need to buy in another asset, a taxable asset, right? Because we got to remember, life insurance, it's going to be tax free. If he were to seek out a taxable asset, he would have to get over a 9% rate of return on that asset. When you take away the taxes, that would net him the same amount as life insurance, which I would argue that is hard to find, and that's the benefit of a guaranteed death benefit when we're talking about legacy planning. So now, I've gone over that example. Who would be a good client for that scenario? Certainly, like I said before, clients who are more focused on what am I going to leave behind? What am I going to leave behind to my kids? What am I going to leave behind to my grandkids, to a charity? People that are looking to leverage dollars. Certainly, if clients have estate tax issues, whether that be a federal estate tax or in whatever state they live in, they could be impacted, and they're saying, you know what, I want to pay less in taxes. Let's purchase some guaranteed death benefit life insurance to help offset that and leverage the dollars we have today into something greater. The last example I'm going to go over is a product that's unique to North American. The only product I know of in the industry that can do this, and I'll talk a little bit here in a second on why. But to get there, I want to show this example of, we're looking at a 65-year-old female who's got $250,000 in lazy assets. So when I say lazy assets, I'm talking about money that's in, a bank account, money market CD, under a mattress. It's money that a client has clearly identified as something they don't want to put at risk, right? Like, the reason it's not invested is because they don't want any chance to lose it. It's probably not something they're going to use for income and retirement. They may need it as an emergency fund down the road. If you were to ask them what's the ideal scenario, it would be that they don't tap into the money and they get to pass it on to their family. But again, it's kind of, they need it to be somewhat liquid, and they don't want it to be put at risk. And that's, again, that's what I identify as lazy money. And so what you can see here in our Smart Builder product, that $250,000 is going to this life insurance policy. What's unique about this product is it does not have a premium load. Just about every single product in the industry has a premium load. This one does not, which allows for a high early cash value. $250,000 in, we credit at a minimum. Our guaranteed minimum crediting rate is 2.5, which is what you're seeing in the middle column, the 2.5. The column all the way on the left is assuming we would charge the max amount of charges, the max COIs, and credit 2.5. So the middle column is really the lowest case scenario, right? It's current charges and 2.5 crediting rate. $247,000 and change. A guaranteed 97% cash surrender value in year one. By year two, you can see the client has recouped $250,000. In fact, they exceed that. If you look at the column on the right, at 5% in year one, they would immediately be above water in that scenario. But you can see here, if I highlight that middle column, talk about safety, talk about liquidity, right? This client can walk away in 10 years with a minimum of $289,908. Not to mention, if the index actually performs above that, she'll get more. But at the minimum crediting, the minimum guaranteed crediting that we have, 2.5, you can see the safety and the liquidity that this product provides. Not to mention, by the way, that death benefit all the way on the right, if she were to get sick in year 10, right? Let's say she gets Alzheimer's or dementia, she's not going to accelerate off the cash value of 200 and something thousand or even 300 something thousand. She's accelerating off the death benefit of over 500,000. And so that's a real big benefit for her to think, man, if I left this money in the bank, I get Alzheimer's, I need some money to pay for medical expenses, I'm going to be tapping into that 250,000 or whatever it has grown to. But with this product, I not only have the liquidity and the safety, but now I've got the leverage of that death benefit, not only if I die, but if I get sick as well. So here on the bottom line, you can see, again, that's the guaranteed values at 5%. That would be the line above that. and then the leverage you get on the death benefit, which is really important. Again, not just for thinking about death, thinking about if I'm critically or chronically or terminally ill, I would be able to tap into that higher line there. This just shows, what you would need to get in the CD to try and mimic these same returns. This has been an extremely popular option for clients who have lazy money and are saying, you know what, I want safety, I want liquidity, I like leverage, I like the upside potential. If the index returns, that's additional money I didn't even expect above and beyond. Our average client who purchases this is in their 60s. You can see, anyone probably over age 50 would be an appropriate candidate for this. We don't necessarily see people in their 30s or 40s, who want to purchase this product. This is a single premium product. You can dump up to $2 million in it. And if you're thinking, Andrew, I like that story, that year one, 97% guaranteed cash surrender value is attractive, but it's not attractive enough to give my client peace of mind. We do have a rider that gives you 100%. So I didn't illustrate it just because the long-term performance drags a little, but for clients who are saying, I need 100% liquidity, guaranteed 100% liquidity, day one, we would add that rider on. And in my example, you dump in $250,000, you would have $250,000 guaranteed to be liquid in that first year. So again, I think 97% is a powerful enough story, but for people who need to see 100%, we do have an option for them as well. So lastly, I'll close by, I know I went through a number of examples. We started out talking about the regulatory changes on Index Universal Life that are coming May 1st. And certainly I highlighted hopefully some opportunities today that I hope, again, that you can take back to your own practice. But I lastly want to close on why North American. One of the strengths that we have is breadth of product, right? We understand that some clients that you might have clients that fit those scenarios that I showed you, right? You might have a client who's looking for a tax advantage asset. You might have a client who's looking for a guaranteed death benefit that they can dial all the way to age 120. You might have a client who fits that single premium scenario and is looking for that liquidity and that safety. But if you don't, we also have term insurance, right? We have the lowest cost term insurance in the market with living benefits and conversion options. We're one of the few carriers still has a true GUL guaranteed universal life product. So we've got a really, a diverse portfolio that can meet your clients wherever they're at on the spectrum, wherever they're at, if they're coming out of college all the way to, if they're in their 70s, we've got a client or product that can meet your client's need. And the living benefits, which I talked about briefly, right? The critical, chronic, and terminal illness rider are included on all of our products. Term insurance, the GUL, the GIUL, accumulation IUL, the single premium product. I think especially in term insurance, it's easy to talk about. You buy a 20-year term to protect your life over the next 20 years. But what if you don't die over the next 20 years? What if instead you have heart attack, cancer, or stroke? Wouldn't you like a life insurance policy you can tap into for those reasons, right? And I mentioned Alzheimer's and dementia would certainly qualify under chronic illness as well. And just know that those living benefits are included in our entire suite of products. But beyond products, process is equally as important. It's no good if a carrier has an attractive product, but they can't process the business behind the scenes. And we're one of the easiest carriers to work with from start to finish, right? You never have to leave your office. Your clients never have to leave their home. We can do electronic app, electronic signatures, accelerated underwriting, e-delivery, again, to make the entire process seamless and easy. And by the way, with our accelerated underwriting product or accelerated underwriting program, that is available for ages 18 to 50 up to $2 million and ages 51 to 60 for up to $1 million. We've got a very high approval rate compared to the industry with our accelerated underwriting, which currently is over, I think, 57%, last numbers I saw earlier this week. But you can see here, right, the offers that we've had over the last rolling 12 months, over about 90% of our offers have been standard or better. Nearly half of the business, nearly half the offers we've made were preferred or super preferred. We're very competitive when it comes to underwriting. We're very competitive when it comes to process times and getting business out the door, because we know that it's important not just to give clients the coverage they need, but for ease of business for those agents and advisors working with us, we want to get you paid as well, and having you focus on your business instead of when is this carrier going to issue a policy and approve it. We've got a host of marketing resources and tools. If any of the things I talked about pique your interest at all, or you want to get additional brochures or information on the product or the sales concepts that I covered, feel free to reach out to your team at US Advisors. They'll put you in contact with me, and together we'll get you exactly what you need. And lastly, I'll talk about, North American as a carrier, right? I know that there's a number of carriers that you have access to, and a lot of good ones at that. But I pride ourselves in the story we've had, and we've been in the business over 100 years. We're a U.S. domiciled company. We're privately owned, and that's really important because if you've been in the life insurance space for the last decade plus, you've seen a number of carriers make changes, be sold off, spin off, whatnot. And a lot of that is dictated by shareholders, right? And how do we please Wall Street for this quarter at the expense of the advisor, at the expense of the agent, unfortunately at the expense of the consumer? Because we are a private company, we don't have to make those short-term decisions. We make long-term decisions. We know that this is a promised business, right? And we've been making promises for over 130 years. We want to continue doing that well into the future. We're well capitalized. We're highly rated, and we're here for the long haul. So my hope is that hopefully something that I covered, this afternoon is an idea, is a tool that you can take back to your practice to help benefit your clients in retirement. So with that, again, Rod, appreciate the invitation today and the ability to be with you all.
That's beautiful. Yeah, I really appreciate it. Wonderful presentation. You guys can see how great North American is, how great Andrew is. And we want to pay close attention. He gave you 3 scenarios, right? And in those scenarios, what that really amounts to is we got to find the right client and have kind of the right conversation. And the right conversation is always a focus really on what insurance can do, not necessarily what insurance is, but what it can actually do. And it can be a non-correlated asset when we're focused on death benefit. It can be a beautiful diversification away from the market, a diversification away from taxation. Many people who implement IUL contracts at the very end of the day are comparing the cost of taxes to the cost of insurance. And so oftentimes the insurance conversation gets thrown away. And so what we believe is that if we have the right client with the right kind of conversation, all we have to do is effectively educate them so that they can have consideration about whether or not this asset class, because that's really what it is. And it's an asset class that has complementary attributes that no other class has. That internal rate of return analysis is the single most important one, in my opinion, to determine whether it's, quote, a good deal or a bad deal. I think Andrew's very fair when he talked about those returns and the taxable equivalent yield. But if you look at an early death, right, he's talking about over 30 years, which I think is very, very fair. But the fact is that some of our clients are going to die early. And when you look at the math of that, right, people aren't thinking generally about getting a great return in their insurance. Now, sometimes you might have to die for that to occur, but again, we're talking about an asset class that is different than the other assets. And when you start thinking about transfer taxes, including estate taxes, state estate taxes, income taxes, you think about the 10-year rule for inherited IRAs for non-spousal beneficiaries. Okay, a guy like me, 45 years old, at the peak earning of my career, the last asset that I want to inherit is an IRA. I'm not going to be upset if I do inherit an IRA, but I'm going to have to push that into my income. I don't want the income, right? I want that for retirement. Too bad, you got to take it. And the worst part, of course, is that it's going to be right on top of my already earned income. So I'm going to pay at my highest marginal bracket. So let's educate clients so we can get consideration for that. I want to spend the last 5 minutes and share with you a couple of tools that we have. Of course, I'm sharing the wrong screen. A couple of tools that we have that you could take advantage of if you want to reach out to us. Okay, now, first of all, I don't know if any of you have seen this debt clock. I could spend 15 minutes on this. This thing just piques my interest so much. Okay, debt's bad, right? Look at this US debt, 31 trillion, and this is real time, just going up. A couple of things just to give you quick. If you haven't looked at this, I suggest you do. maybe even share it with clients. I've shared it with a lot of clients, and you can get in some really interesting conversations. They have a debt clock time machine. You can go back in the future, you can go in the forward, right? So what has it been and what is it likely to be? You can drill down by state, right? Uh, you can toggle in between the states. You can move back and forth. You can actually go into world debt clocks. Here's the state debt clocks. So just want to share that little piece with you. If you haven't seen it, take a peek at it. I teased you at the front that we have a great white paper from one of our partners called Partners Advantage that outlines 6 strategies to help include and enhance IUL success, right? And again, this would be something I could spend 30 minutes on, but big picture, they're giving us 6 different success strategies. We kind of talked a little bit about these today. Find someone willing to buy. Well, that's a different language than mine, but we got to talk to the right kind of person, right? Sell to people's problems. Well, this is about what insurance does. You don't ask people if they want insurance. The answer to that question is no, I don't want insurance. We have to ask them what's important to them about their legacy, what's important to them about their family, what kind of goals do they have, right? And then we can show them and demonstrate how insurance can help facilitate those goals, right? Generically, on the first day of sales school, I learned that we want our clients to be successful, whether they live a long time, whether they die early or become disabled along the way. Well, it sounds like Andrew addressed a lot of those inside those products, right? And those designs with living benefits. And if they die early, we have the lump sum to create a supplemental income for the family. They become disabled. Maybe we have this chronic illness, the ability to do that, right? If they live, well, guess what? We might be able to create a supplemental retirement income bucket for them that doesn't require us to redeem shares in down years. Right? We talk about the zero being great in a down year where we didn't lose anything. I think the best part of the zero is not the zero, it's the next year, right? Because we get all the growth off of the floor, right? If we're in the market and we're down 10% in year 1, in year 2, we go back up 10%, guess what? We're still underwater, right? Well, not here. If we're down 10%, we get 0. Then we're up 10% the next year, we get whatever our cap is. Right? So I happen to think that's the best part of the zero is the annual reset on that basis. Becoming an expert. Well, listen, we don't have to be expert salespeople. We have to be expert problem solvers, right? Understand what our clients need, be able to educate them so that they can make very good decisions for themselves. After all, that's what our real job is to motivate our clients to operate in their own best interest. Okay? You hear us talking ad nauseum about you have to have a plan to be able to do this intentionally. So they have a success strategy number 4, have a system, got to set goals. What does that mean? Who are we going to talk to? What does it look like? Right? And then improving efficiency and aligning with trusted partners. If you like what you're hearing here, but you don't either have the confidence or some of the technical knowledge, or maybe you're not comfortable approaching these type of conversations, think of us as well. I do a lot of joint work. So we help people identify people to talk to, position how to talk to them, and then help them either implement or introduce other specialists. Our best clients need multiple specialties: estate planning attorney, wealth advisor, insurance specialist, accountant, etc. And generally, you don't want to look at those items in a vacuum. You want to have that in a coordinated effect. So again, reach out to George and our team, Andrew on our team, or reach out to me if you want any of these items. Andrew did a great job with identifying people for those 3 strategies. Well, we have a who do you know sheet as well that has about 12 different opportunities. Again, we could spend a whole coach's corner on these different opportunities, but this would be the first thing that I'd be looking at if I wanted to intentionally integrate insurance. I go, well, where are the opportunities? And then I would match who are the clients we need to talk to about those opportunities. And then I would call George, I would call Andrew, I would call me and say, okay, can we talk about these clients? How do we best approach them? Right? And that's what this tool is really designed for. Okay. What we have here is we have a very nice article on AG49. This was put together by a guy named Bobby Samuelson. I happen to think he's probably one of the best thought leaders in the insurance marketplace, and I really like listening to him and I like reading his stuff. I think this is a good article if you want to know a little bit more technically. Again, reach out to us and we can share that. Andrew mentioned that Ernst & Young white paper. We have that. So if you want to reach out to us, we'd be happy to send that to you. The last tool I want to show is this tax challenge, which again, Andrew alluded to this, right? Tax now, tax later, tax never. Can't really say tax never again. And if you literally sit down with a client and you inventory where their assets are, what you're going to find is that very few of them are in these don't tax me again, especially our best clients, right? Because they're not eligible for Roth IRAs. Even if they are, they're capped. We're doing backdoor. I mean, there's different ways to do it, backdoor Roth conversions. But the fact is, this is a great starting point to be talking about the cost of taxes. What I find in working directly with clients is certainly they understand that taxes are high. I pay a lot in taxes. Nobody really thinks about that being a true bona fide cost. And they definitely don't think about the fact that some of that cost is actually voluntary. We don't have to always pay taxes on everything all the time. And so we educate and then we get consideration. All right. So with that, I want to show one last thing, which is the call to action here is that if you liked what you heard here today, reach out to me or George or Andrew and discuss your next client. I mean, that's where the magic happens. We do Coaches Corners every single month on the third Thursday of the month. The next Coaches Corner is the 18th of May. We're going to be featuring One America. And One America is one of our great companies as well. They happen to have a very good solution for qualified money to fund long-term care. And they happen to have a second to die structure with long-term care riders. And those are two very unique things about this company that other companies don't have. So think about tuning into us. And so with that, Andrew, I'll send back to you for any final thoughts. And in the meantime, I'm going to give you Andrew's, George's, and my contact information. So Andrew, last thoughts from you if you have any. I got you, Andrew. I don't think he's hearing me, maybe.
Me?
Yeah,
I
Andrew.
thought you were talking to Andrew.
Oh, I meant you, Andrew.
I saw Andrew Casillas' information. I'm like,
Yeah.
Andrew Casillas is going to let us go. But no, I just appreciate the partnership with U.S. Advisors. Thank you, Ryder, for having me on. Hopefully we generated some thinking, and hopefully you'll think of clients that would be good for one of these solutions.
That's beautiful. I appreciate it. I confused you. I shouldn't have done that. So in either event, I want to thank you guys again for attending, and I'll close this like we close our Monday morning meetings. Let's be good leaders. Let's help our clients, and let's drive revenue to our practices. So I appreciate you all. Have a wonderful weekend. Take care, everyone.